My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate how to compute basic earnings per share. Okay, so in this video, we're going to concentrate on the measurement issues related to earnings per share. And I have an example to walk our way through, Parnell Corporation. There's a lot of data here, but we'll just have to work our way through it piece by piece. Parnell Corporation on December 31st, 2011 had 1.2 million shares of common stock outstanding. On January 1st, 2012, they decided to issue some convertible preferred stock, not common stock, but preferred stock. We'll come back to that later. On April 30th, they purchased some 60,000 shares of common stock, and on August 31st, they reissued some of those shares out of Treasury. They paid some dividends during the year, and for the year ending December 31st, 2012, they reported $1.56 million of income. So what we need to do, earnings per share, conceptually is pretty simple, is just earnings, our net income that's available to the stockholders, divided by the number of shares outstanding. The problem here is that we have a handful of common stock transactions that occurred during the year, and so it's not just 1.2 million shares that were issued and outstanding at the beginning of the year, but the number of shares outstanding at any point in the year is changing because of various stock transactions. And so what we need to do is we need to first determine the weighted average number of shares issued and outstanding. And what we're going to do with determining that is basically working with a timeline. So we've got a very simple timeline, represents the full year. And Parnell, as of January 1st, 2012, December 31st, 2011 is the same thing as January 1st, 2012, had 1.2 million shares of common stock outstanding. Now, what happened on April 30th is that we went into the market and repurchased some of those shares, made a treasury stock transaction, and we specifically purchased 60,000 shares of stock. So that means that as of April 30th, the date in which that transaction took place, there is now only 1,140,000 shares outstanding. We had 1.2 million shares outstanding on January 1st. On April 30th, we went into the market and repurchased or took out of circulation 60,000 shares of stock. That reduces the number of shares outstanding to 1,140,000. On August 1st, we went and resold or reissued some of those shares. Specifically, we went back and resold 24,000 of those shares. So on August 1st, 2012, there is now 1,164,000 shares outstanding. So 1,140,000 plus the 24,000 shares that were reissued on August 1st tells us that we have 1,164,000 shares of common stock outstanding. And there were no other common stock transactions for the remainder of the year. Notice that there is nothing in here about the preferred stock. Preferred stock is a separate class of stock, and it doesn't have anything to do specifically or directly with the number of common shares outstanding. And so these numbers and dates represent the numbers of shares that were outstanding at specific points in time. In order to determine the weighted average common shares outstanding, what we're going to do is weight each one of these values for the proportion of the year for which those number of shares were outstanding. So for example, from January 1st to April 30th is 4 months. We've got all of January, February, March, and April. So we had 1.2 million shares of common stock outstanding for 4/12 of a year. Then on April 30th, we went into the market, made that treasury stock transaction and reduced the number of shares by purchasing 60,000 in the open market. And so now the number of shares outstanding is 1.14 million, and that 1.14 million remains in existence for 3/12 of a year. From the end of April or beginning of May, we've got May, June, and July. Notice that this is August 1st, so we don't count August. This is kind of similar to one of the things that we had to pay attention to when we were computing accrued interest on notes payable. You have to pay attention to how long or what portion of a year something is outstanding. In this case, we're looking at the number of shares outstanding as 1.14 million for 3/12 of a year. Then we went back and reissued some of those treasury shares, specifically 24,000. So now the number of shares issued and outstanding is 1,164,000, and that's true for 5/12 of a year. From August 1st to December 31st is 5 months. So we've got August, September, October, November, December. That's 5/12. You can kind of check to make sure that you've got your months correct. Your numerators have to add up to 12, right? There's 12/12 of a year. So 4 plus 3 plus 5 is 12/12 of a year. Once you get that laid out in terms of a timeline, then the calculation is actually pretty simple. We take the number of shares outstanding and multiply it by the portion of year for which those shares are outstanding. And so our calculation is going to be 1.2 million times 4/12 of a year, and then 1.14 million times 3/12 of a year, and 1.164 million times 5/12 of a year. We take those weighted values and add them up, and that's the weighted average number of shares outstanding. So we started out the year with 1.2 million, we ended the year with 1,164,000, and somewhere in between the two is our weighted average. And that's what we need in order to compute or determine the denominator for earnings per share. The 1,170,000 shares is our weighted average number of shares outstanding. And so now we can move on to calculating the earnings per share. The first thing that you want to recognize is that basic earnings per share is the after-tax income available to common stockholders divided by the weighted average number of common shares outstanding. So we just determined the weighted average number of common shares outstanding. That's the 1,170,000. What we need is after-tax income available to the common stockholders. After-tax income available to the common stockholders is our after-tax income minus any preferred dividends that we have to pay. And if you remember what we had to do on or in the data to the problem, let me skip back here to the beginning of the problem, and just give me a second. So what we had to do here was recognize that there were some preferred stock that were issued. Now that doesn't affect the number of common shares outstanding, but remember, preferred stock gets preference with respect to dividends, and dividends were paid this year. Total of $350,000 in dividends were paid, but some of that was paid to the preferred stockholders. So income that is available to the common stockholders is our after-tax income, 1.56 million, minus whatever dividends we have to pay to the preferred stockholders. So we've got 40,000 shares of preferred stock times $100 par value times 7% will tell us the amount of dividends that were distributed to the preferred stockholders. So let me cycle through the problem here and get back to that worksheet. And so the net income here is 1.56 million less the dividends paid to the preferred stockholders, which amounted to 280,000. So out of the $350,000 in dividends that we paid, in total 280,000 went to the preferred stockholders. That's just number of shares times their par value times the dividend rate, in this case 280,000. That leaves us with income available to the common stockholders of $1,280,000. So now we have our numerator, $1,280,000, and we have our denominator, 1,170,000 shares. And so basic earnings per share is $1.09. That is the net income available to the common stockholders divided by the number of shares outstanding, or weighted average number of common shares issued and outstanding for the year. That is what's known as our basic earnings per share, or basic EPS.